Every morning at Zacks.com, the newest Zacks Rank #1 strong buy stocks are available. Simply buying the stocks with the Zacks Rank #1 and then selling them when they're no longer ranked in #1, which means a 2, 3, 4, or 5, has handily beaten the market. In fact, since 1988, the Zacks #1 ranked stocks have generated an average annual return of 26.25%, which is nearly 3 times that of the S&P's 9.98%. Understand, this is not just 1 year or a couple of years. Over the last 27 years, the Zacks Rank #1s have beaten the market in 23 out of the last 27 years. That's an annual win ratio of over 85%. This includes bull markets, bear markets, and everything in between. What's exciting is that if you're able to do this year after year, over and over again, that can add up to a lot more than just 3 times the S&P. A hypothetical $10,000 investment back in 1988, excluding brokerage commissions and fees, would have grown to over $6 million, while the S&P would have increased to just $148,000. You know, we've all heard people say that becoming a better investor can change your life. While it's a great catchphrase, I don't think anybody really stops to think about it, let alone believes it. But it's true. While we can't go back in time, let's take a look at 2 investors over the next 10 years. One is able to earn the average Zacks #1 rank return of 26% a year, while the other earns the average 9.98% return of the S&P. At 26%, a $100,000 investment over the next 10 years would show a compounded return of over 908%. That $100,000 would have grown into over $1,008,000. At only 9.98%, that $100,000 would have compounded into just 159%, increasing to only $259,000. Becoming a better investor can change your life. Just ask the guy who's going to retire on $250,000 versus the guy who's going to retire on $1 million. And tell me that the guy with $1 million isn't living a different life than the guy with $250,000. Now imagine you're not even earning market returns. Sadly, too many investors are not even coming close to that. Becoming a better investor can, indeed, change your life. In 1978, Zacks Investment Research was formed to compile and analyze brokerage research for both institutional and individual investors. Today, Zacks processes this information from roughly 3,000 analysts at over 150 different brokerage firms. At any given point in time, we're monitoring well over 200,000 earnings estimates and other related data, looking for any change. Our ability to gather, analyze, and distribute this information on a timely basis makes Zacks research among the most widely used investment research on the web. The Zacks Rank was created by Leonard Zacks, the CEO and founder of Zacks Investment Research. Len, who has a PhD from MIT, spent many years on Wall Street testing statistical models to help uncover ways to beat the market. This research led to the breakthrough discovery: earnings estimate revisions are the most powerful force impacting stock prices. His findings were first published in 1979 in the Financial Analyst Journal and entitled EPS Forecasts: Accuracy is Not Enough. From this seminal work emerged the now famous Zacks Rank stock picking system, which harnesses the power of earnings estimate revisions. And so began a long tradition of innovation by his renowned firm, Zacks Investment Research. Len may be a PhD, but you don't have to be one in order to take advantage of the Zacks Rank. Now, the Zacks Rank uses 4 factors related to earnings estimates to classify stocks into 5 groups, ranging from strong buy to strong sell. But more importantly, it allows individual investors to take advantage of trends in earnings estimate revisions and benefit from the power of institutional investors. Investors like Tim Malley of Madison, Wisconsin, who writes, "I don't buy a stock unless Zacks says it's a strong buy."
People who trade stocks are broadly defined into one of 2 groups: institutional investors and individual investors. Institutional investors are the professionals who manage the trillions of dollars invested in mutual funds, investment banks, hedge funds, and the like. Individual investors, also referred to as retail investors, are people who independently invest for their own private accounts. Studies have shown that institutional investors, who account for roughly 70% of the trading volume in stocks, can and do move the market due to the large amounts of money they invest with. Because of this, the market has a tendency to move in the same direction as these institutional investors. Here at Zacks, we have always known about the power of the institutional investor. Through the Zacks Rank, you can benefit by getting into the stocks that are highly sought after by these large professionals due to their focus on earnings estimate revisions. Most institutional investors attended prestigious business schools where they were taught a number of classical financial models, many of which were designed to calculate the fair value of a company and of its shares. Almost without exception, these valuation models focus on earnings and earnings estimates. Very simply, if you raise the earnings estimates used in the model, then it will create a higher fair value for the company and its stock price. For example, if an analyst believes a stock is worth 20 times next year's earnings, a PE of 20, with an earnings estimate of $1 per share, that's $1 estimated EPS, then it would be under its fair value at any price below $20. That's a PE of 20 times the $1 earnings estimate, equaling $20. If the analyst changes his forecast and believes the company will instead earn $1.10 per share, the fair value would then be $22. That's the PE of 20 times the new estimate of $1.10, equaling $22. Institutional investors then act on these changes in earnings estimates, typically buying those companies with rising earnings estimates and selling those with falling earnings estimates. As you can see, an increase in the earnings estimate can translate into a higher price for the stock and bigger gains for the investor. It's also important to note that it can take weeks, if not months, for an institutional investor to build a position given their size. The individual investor, however, who can get in at the first sign of upward earnings estimate revisions, like those with a new Zacks #1 rank, has a distinct advantage over these larger investors and can benefit by the expected institutional buying that will follow. It's why Keith S. of Tulsa, Oklahoma writes, "I started using Zacks in 2003 and have beaten the market every year since then."
The best and most widely used source of earnings estimates comes from the brokerage analysts who track publicly traded firms. These analysts work hand in hand with company management and independently to analyze every aspect that may affect future earnings. Analysts are paid in aggregate over $1 billion a year to analyze stocks. They must know something, and they do. The typical analyst at a brokerage firm will work 80-hour weeks, devoting all of his/her time to, at most, maybe 20 companies. And many companies are followed by 5 to 10 analysts or more, 30 or 40 for the biggest ones. One of the main tasks is to determine what a company's earnings will be. This is where they excel, not in their ratings, but in their earnings estimates, also known as earnings per share or EPS estimates. From these individual analyst estimates, Zacks creates a consensus EPS estimate, which is the average of all estimates made within the last 120 days. Older estimates are not included. Zacks calculates this consensus estimate for each of the next 4 quarters, each of the next 3 years, and as a growth rate over the next 5 years. These consensus estimates are the benchmark by which the company will be judged by the investment community. When trying to determine the future direction of a stock's price move, you need to look at what a company will earn in the future. This is why earnings expectations or earnings estimates are so important. And it's the change in the earnings estimates, earnings estimate revisions, that have proven to be the most important. This is because stocks that receive upward earnings estimate revisions are more likely to receive even more upward earnings estimate revisions in the future. This is true because many analysts will revise their earnings estimates slowly and incrementally. For example, If an analyst raised his earnings estimates last month, he's more likely to do it again this month, and the other analysts are likely to do the same. Since stock prices respond to earnings estimate revisions, it's very profitable to buy stocks whose earnings estimates are being raised. And by getting into stocks whose earnings estimates are being raised, you're likely getting into companies whose future earnings estimates will be raised as well, potentially influencing stock prices even more. That's why Lowell Womack of Birmingham, Alabama wrote in to say, "I've bought many stocks over the past 3 years based on the Zacks Rank and made money. Too many to mention names."
Given the sheer number of earnings estimate revisions made on a daily basis, it can be very difficult to determine which stocks to buy and which ones to avoid. The Zacks Rank solves this problem by helping investors harness the power of earnings estimate revisions to invest more successfully. The Zacks Rank is a proprietary stock rating model that uses trends in earnings estimate revisions and EPS surprises to classify stocks into 5 groups. Number 1, strong buy. Number 2, buy. Number 3, hold. Number 4, sell. And number 5, strong sell. A portfolio of Zacks number 1 ranked strong buy stocks has beaten the market in 23 of the last 26 years with an average annual return of 26.4%, which is nearly triple that of the S&P's 9.9%. These returns have been examined and attested by Baker Tilly Virchow Cross, LLP, an independent accounting firm. Over time, this kind of outperformance can add to a lot more than just 3 times the S&P. An investment of $10,000 back in 1988 using just the Zacks number 1 ranked stocks would have compounded into over $3.9 million, while the S&P compounded into only $112,000. That's a big difference. Take a look at the equity curve of the Zacks number 1 ranked stocks and notice how the Zacks Rank has completely erased the pullback of the financial crisis that started in Q4 of 2007 and ended in Q1 of 2009, and has made new highs soaring above the pre-crisis peak. It took the S&P a full 2 years later to finally make new post-crisis highs. Implementing ways to consistently beat the market can quickly add up, helping investors transform their portfolio. Clarence Feiner of Reading, Pennsylvania agrees when he states, "The Zacks number 1 rank leads me to stronger stocks." So, how does Zacks use earnings estimates and earnings estimate revisions in the Zacks Rank? The Zacks Rank is calculated from 4 primary inputs: agreement, magnitude, upside, and surprise. Agreement is the extent to which all earnings estimates are being revised in the same direction. The greater the percentage of estimates moving higher, the better the score will be for this component. For example, if 70% of the analyst estimates are increasing for a stock, whereas only 40% are increasing for another, the higher the percentage of upward revisions, the better. In this example, there are 12 estimate revisions, all moving higher in the last 60 days, and no estimates going down. This shows a 100% agreement amongst the analysts making estimate revisions, and they're all up. If, on the other hand, half were revising their estimates up and half down, that would mean 50% of the estimates were positive. Not much of an agreement. And if the majority of the revisions were down, that would show clear agreement, but to the downside, which means it would score poorly on this component. Magnitude is the size of the recent change in the current consensus estimate for the fiscal year and the next fiscal year. For example, a 5% increase in the consensus estimate is better than a 2% increase, and will thus get a better score for this component. Seeing the analysts who cover these stocks for a living ratcheting their estimates up over and over again is a powerful indication of increasing earnings to come. On the other hand, if the consensus flits up and down, implying uncertainty and mixed views on the company's bottom line, it'll score poorly on this component. And if the consensus estimate trend is down, it'll score even worse. You can also see the consensus trend visually displayed in our price and consensus chart. This lets you see at a glance which way the consensus is heading and the relationship between it and the stock price. So you want to look for stocks whose consensus is rising and preferably at a steeper angle than the period that preceded it. Upside is the difference between the most accurate estimate as calculated by Zacks and the consensus estimate. A positive difference between the most accurate estimate and the consensus is better than a negative one. And like the other factors, bigger is better. The difference doesn't have to be huge though, but it's a leading indication on the direction of the consensus. The surprise factor looks at the last few quarters of earnings surprises as well. Companies with a positive earnings surprise are more likely to surprise again in the future or miss again if recently missed. For this reason, looking at a company's recent surprise history can be a great aid in forecasting the surprise likelihood of their next outing. You can also see the surprise history by looking at the price and surprise chart, which uses red and green arrows to depict the company's surprises. A visual scan of the price and surprise chart can quickly orient you on a company's ability to surprise in the past and their likelihood of doing it again. Each one of these components is combined into a composite score and is recalculated every night. These scores are then compiled into the Zacks Rank and are made available to investors every day, helping them beat the market. That's why Don T. of Sisters Oregon writes, recommendations have been spot on. 9 winners, up 35% already. Let's take a look at some practical examples of how the Zacks Rank can get you in and keep you in on some of the most profitable stocks. Whether it's a widely known large cap stock, little known small cap stock, or somewhere in between, the Zacks Rank works and the steps to success are the same. Manpower Group, ticker MAN, is a leading employment services company in the U.S. and abroad. Even though they're well known in their industry, it's not one of those names most investors are familiar with. But it's definitely a name Zacks customers are familiar with now. On June 28, 2013, the stock, which had been in a trading range for months, got the signal that alerted investors that it was finally ready to break out. That signal was the Zacks #1 ranked strong buy, which forecast that it would outperform the market over the next 1 to 3 months. At that time, it was trading at $54.80 with an earnings estimate of $3.67. 2.5 months later, and a series of upward earnings estimate revisions, including a positive EPS surprise, MAN had retained its Zacks #1 rank and gained for its investors a 34% return versus the S&P 500's only 5%. Simply put, when earnings estimates are going up, the stock should go up as well. And your best first alert that a company's outlook is improving is a Zacks #1 rank. The Zacks Rank is ideal for getting you in on the most profitable opportunities over a 1 to 3 month period, making the Zacks Rank an excellent timing indicator. But it's also great for getting into stocks that develop into longer-term trades and core holdings. One of the toughest parts of investing is staying in a stock that's going up and not getting out prematurely. For whatever reason, too many investors are quick to cut their profits short and let their losses run. Of course, the opposite of that is what should be done. But by following the Zacks Rank and the trajectory of earnings estimate revisions, not only will you know when to buy, but also learn how to ride your best stocks for bigger gains. And when the time comes, know when to sell. FleetCor Technologies, ticker FLT, is one of those stocks that looked set to outperform over a 1 to 3 month time frame, but then turned into a longer-term holding, resulting in even more impressive gains. The company operates as a provider of specialized payment products in the financial industry, and it quickly became a favorite holding in many portfolios. On August 17, 2012, they were singled out as a top stock when it received the Zacks #1 rank. Even as many investors were still shunning financial stocks, this one stood out from the others, ready to outperform. Over the course of the next 14 months, through October 4th of 2013, they received 59 upward earnings estimate revisions in a row, produced 4 positive EPS surprises, and rewarded investors with a 163% gain compared to the market's 41%. During that time, their 12-month forward earnings estimates steadily climbed from $291 to $425 and was the clear catalyst for FLT's stellar gains. Once you're in a stock destined for greatness, it's important to not get bucked off. To be sure, there were both positive news stories and negative news stories throughout their run-up, and the broader market had its ups and downs. But their earnings estimates kept pointing higher, keeping you on board the entire time. That's why Robert Taylor of Edisto Island, South Carolina wrote, "I've bought several stocks that appeared in the #1 listing that I continue to hold as core holdings."
Momentum traders and investors look to take advantage of upward trends or downward trends in a stock's price or earnings. They believe that these stocks will continue to head in the same direction because of the momentum that is already behind them. We've all heard the old adage, the trend is your friend. And who doesn't like riding a trend to new highs? In fact, studies have shown that stocks making new highs have a tendency of making even higher highs. The Zacks #1 ranked stocks are ideally suited for folks who rely on momentum or technical analysis because it can tip them off before most other systems. Rather than simply looking for price trends, the Zacks Rank is about cause and effect. The cause of the move is positive revisions in earnings estimates. This upward shift in earnings estimates prompts more and more investors to take an interest in the company, with the effect being that the shares in the company start on a bull run. Volume increases, as does the stock price. But simply relying on price movement alone doesn't alert investors until after the move has already begun, costing active traders opportunities to maximize profits. Conversely, by focusing on earnings estimate revisions, the Zacks Rank can identify stocks that are likely to move up in the future before the breakout has occurred. In other words, the Zacks Rank helps traders get in ahead of the price action. Traders like Noel Horkett of New Windsor, New York, who writes, "I have tried numerous services in the past, and I found the Zacks #1 stock picks especially good for my portfolio."
Aggressive growth traders are primarily focused on stocks with aggressive earnings growth, or at least the potential for aggressive growth, which should propel their stock price higher in the future. You'll often find smaller cap stocks in this category because these are typically newer companies that are in the early part of their growth cycle. But you'll also find plenty of mid caps and large caps too. By concentrating on Zacks #1 ranked stocks, growth investors can easily screen for companies exhibiting these stellar growth rates with a likelihood of it continuing. The best part of the Zacks Rank is its ability to alert investors at the earliest stages that a company's prospects are looking very bright. And getting in early on an emerging growth story generally leads to strong investment returns. Many growth investors, however, make the mistake of looking for those with the highest growth rates possible. Unfortunately, many such companies underperform in spite of their outsized growth rates. For example, a company earning 1 cent a share that is now expected to earn 6 cents has a 500% growth rate. But if it receives a downward revision to 5 cents, that's a significant drop. Even though it still has a 400% growth rate, the estimates were just reduced by 16.7%, and the price is likely to follow. Ever wonder how a stock with triple-digit growth rates could possibly go down? That's how. The Zacks Rank, which focuses on earnings estimate revisions, notifies investors at the first sign of weakness, Zacks Rank #4 or #5, providing the opportunity to lock in profits and avoid unnecessary losses. That's why Christopher M. of York, Maine wrote, "Your portfolio is hands down better than any other I have tried."
Value investors are looking for good stocks at great prices. This does not mean they have to be cheap stocks in price, however. The key is the belief that they are undervalued. that they are for some reason trading under what their true value or potential really is. The value investor hopes to get in before the market discovers this and moves higher. Many institutional investors focus on this very thing. Typical value investors will look at valuations like PE ratios, PEG ratios, price-to-book ratios, and more. Too many value stocks, however, have low valuations because they don't have compelling enough earnings or growth rates to speak of. The key for value stocks, however, is really earnings, which is the basis for most valuation models. When the Zacks Rank signals a strong buy or buy, Zacks Rank number 1 or number 2, that means earnings estimates for a stock are rising. Given this new information, other investors will likely view the stock as being undervalued relative to its future prospects. So they jump in, which in turn drives the price of the stock higher. The beauty of the Zacks Rank is that it is also a timeliness indicator, meaning that value investors can use it to identify precisely when a company's prospects are beginning to improve, as opposed to waiting and waiting until it becomes obvious to everyone else. And nothing can make an investor sit up and take notice of a stock faster than rising earnings estimates. Although one should plan on holding on to these value jumps a little longer than a typical growth or momentum investor. And consider keeping it as long as it remains a Zacks Rank 3 or better, as its other characteristics remain attractive to maximize the upside returns. It's why Jim Rosiak of Taylor, South Carolina writes, "Now I have more investing opportunities than I have cash because of Zacks' terrific system. My only regret is that I didn't find Zacks sooner."
Investors looking for both growth and income are generally looking for companies with stable earnings growth and a solid dividend yield. Oftentimes, these companies are more mature, larger cap companies that no longer have the kinds of spectacular growth rates as younger, smaller companies, or like they themselves probably had when they were earlier in their growth cycle. Consider this. An idea that generates $1 billion in profits for a $1 billion company represents a 100% growth rate. But that same $1 billion idea applied to a $10 billion company represents only a 10% growth rate. In other words, it is much harder to move the needle on earnings the bigger a company gets. Many of these companies are generating huge amounts of cash, but because of their size, may not have the growth opportunities they once had. So many of these companies will pay out a portion of their earnings to shareholders in the form of dividends. A growth and income investor will want to look at a number of fundamental factors like a company's balance sheet, its competitive advantage, and its management. But the most tangible proof that a company is worth holding for the long term is earnings. You don't necessarily expect to see explosive growth, but you should look for steady and consistent growth over time. A company that generates solid earnings growth is in a better position to raise its dividend over time too. Here again, earnings estimate revisions are the cornerstone of the Zacks Rank. Whenever you find positive earnings revisions, you will generally find a company moving in the right direction, making it a candidate for long-term ownership. There may be fewer of these stocks in the Zacks Rank number 1 group, but there will be plenty of number 2s, and you might even consider some number 3s for the larger cap companies. As you know, you'll typically have a longer holding period with a dividend-paying stock, but a decline to a Zacks Rank number 4 or number 5 can be an early warning sign that business conditions are worsening, and therefore that it is time to take profits and get out. Tracy E. of Haverhill, Massachusetts shared, "I find the service Zacks provides in selecting and ranking stocks to be very helpful. They do the heavy due diligence investigation before ranking each stock. That relieves me of a lot of necessary work that needs to be done prior to a stock purchase."
As you've seen in these videos, anybody can become a better trader or investor. There's no need to reinvent the wheel or go through costly trial and error. You just have to follow a few proven steps to succeed. That includes using the Zacks Rank, the Zacks Industry Rank, and the Zacks Style Scores. But you will have to make some decisions too. For one, decide what kind of trader or investor you are or want to be. Are you a growth trader or value investor? Do you like momentum stocks, or are you more interested in income-producing dividend stocks? Do you have a little bit of some of those styles or even all of those styles in you? These are important questions to ask yourself. Once you know what kinds of stocks you're looking for, they'll be easier to find. But it's also important to find stocks that are in alignment with who you are or want to be as a trader. Because if you don't, and you instead get into stocks that are not in alignment with who you are or the kinds of stocks that are right for you, you're going to drop that strategy the very moment it hits a rough patch. If you prefer discounted value stocks, but you pick a high-flying growth stock with larger valuations than you're normally used to, you may still make money. But if that stock begins to pull back like all stocks inevitably do, you'll immediately feel uncomfortable with your choice and start looking for reasons to get out. Each trading style, as you've seen, has their own characteristics. So be sure you focus in on the style that's right for you. That's a key component for being a successful investor and for consistently making money in the market. Investing should be fun and rewarding if you're doing it right, not full of dread or trepidation like it is for too many people. But if you follow a proven profitable system that works, as we've outlined in these videos, and apply it consistently, you'll soon have the confidence and the profits to show for it. Make sure your next stock has a Zacks rank of a 1 or a 2. Make sure it's within the top 50% of Zacks ranked industries. Insist on a Zacks style score of A or B from the style that's in alignment with your preferred style of trade. Or better yet, look for one that has an A or B in all of them. And use the other techniques described to trade them for maximum profits and minimum risk. Watch these videos over again or revisit the sections you'd like to review further. This will help you stay on track as you build on your success one trade at a time. So congratulations, you're well on your way to becoming the trader you've always wanted to be and having the kinds of financial success and freedom that goes along with it. From all of us at Zacks, thanks and good trading.